This week for advanced micro devices was a tale of two reactions. The company delivered record quarterly revenue, yet its stock saw a dramatic plunge. That was followed by a sharp rebound as the week closed. Why did investors initially react so negatively to a strong earnings report? And was the subsequent rally a sign that the market sees a buying opportunity in the chipmaker's long-term AI strategy? Welcome to TickerWatch News for Advanced Micro Devices, Week 6, 2026. This is a weekly look at the news and financial developments for the company. Stock Snapshot. It was a volatile week for Advanced Micro Devices following its fourth quarter earnings report. After closing the previous week above $240, the stock fell sharply midweek, dropping more than 17% in a single session to around $200 level. However, shares rebounded strongly toward the end of the week, closing on Friday, February 6th, around $208, leaving the stock down about 12% for the week. The price action was accompanied by heavy trading volume, especially after the earnings announcement. The late-week recovery occurred alongside a broader rally in chip stocks, even as the tech sector faced pressure from concerns over AI-related spending and valuations. Top news and headlines. The biggest story of the week was the company's fourth quarter 2025 financial results. AMD reported record quarterly revenue of $10.3 billion and adjusted earnings per share of $1.53. Both figures comfortably beat Wall Street expectations. The data center segment was a standout performer, with revenue growing 39% year-over-year to a record $5.4 billion, driven by strong demand for EPYC server processors and Instinct AI accelerators. Despite the strong performance, the company's forecast for the first quarter of 2026, projected at a midpoint of $9.8 billion, was viewed as cautious by investors. While this represents a robust 32% year-over-year growth, it signals a sequential decline from the record fourth quarter, which seemed to temper expectations for immediate explosive growth from AI. The initial market reaction to this guidance was a sharp double-digit decline in the stock price. Next, AMD announced key developments in its AI strategy. The company confirmed a multi-year GPU supply agreement with OpenAI, a major validation for its Instinct accelerator platform as a competitor in the AI training space. This partnership will see AMD supply hardware for large-scale deployments over several years. In addition, AMD expanded its partnership with Gigabyte. This collaboration aims to integrate AMD's AI technology more deeply into consumer products, including AI-powered gaming laptops and motherboards, extending the company's AI reach from the data center to a broader consumer base. Finally, reports this week highlighted ongoing supply chain issues affecting the industry. AMD has reportedly notified customers of constraints and longer wait times for some of its server CPU products, with delivery timelines extending to 8 or 10 weeks in certain markets. These shortages appear to be driven by a combination of surging demand for AI infrastructure and tight production capacity for leading-edge components. While strong demand is a positive indicator, these constraints could limit revenue in the near term. Market reaction and investor sentiment. The market's sentiment toward AMD this week was complex and shifted dramatically. The initial reaction to earnings was bearish, with the stock's sharp fall indicating disappointment with the near-term growth forecast. However, sentiment appeared to turn more bullish as the week progressed. Many analysts saw the sell-off as a buying opportunity, emphasizing the company's long-term potential. Analyst ratings largely reflect this long-term optimism. Baird reiterated an outperform rating with a $300 price target, citing strong AI demand. Bank of America raised its target to $280, and Morgan Stanley, while slightly trimming its target to $255, still sees significant upside from current levels. The prevailing narrative suggests that while the AI revenue ramp may be more gradual than some had hoped, the company's fundamental position remains strong. One report did flag significant insider selling over the past 3 months as a potential risk factor for investors to consider. Technical and fundamental check-in.
From a technical perspective, the post-earnings sell-off pushed the stock price below several key moving averages, which is often seen as a bearish signal by traders. However, the stock found support around the $200 level and bounced strongly, suggesting buyers stepped in at that price. On the fundamental side, valuation remains a key topic of discussion. The company's price-to-earnings ratio is elevated, trading in a range of 73 to 79 times earnings, which is considerably higher than the semiconductor industry's average of around 44. This suggests high growth expectations are priced into the stock. However, some valuation models based on discounted cash flow suggest the company may be undervalued relative to its long-term earnings potential. The narrative for the company remains centered on high growth, offset by risks from intense competition and execution on its product roadmap. What to watch next week? Looking ahead, investor focus is firmly on the second half of 2026. The company's next-generation MI450 AI accelerator is scheduled to begin shipping in the third quarter, with a significant revenue ramp expected in the fourth quarter. This launch, along with the rollout of the Helios rack-scale AI platform, is seen as a major inflection point for the business and its ability to compete at scale in the AI market. Key price levels to monitor will be the recent support level around $200. A failure to hold this level could signal further downside, while a sustained move higher would need to overcome resistance at the technical levels breached during this week's decline. For the near term, a base case scenario sees the stock consolidating as the market waits for more concrete evidence of the accelerating AI revenue that is anticipated later in the year. Thank you for tuning in to TickerWatch. This podcast is for informational and educational purposes only and does not constitute financial advice. Be sure to subscribe, leave a review, and share this episode.